Right. Okay, well, we're just going to have to go like this. Never mind. So, welcome. It's good to go and have you here. So today what we're going to be going and doing is talking a little bit about what you can do in terms of your options to invest when you don't have any money, and some of the things that you can also do when you do end up having that money. So today what we're going to do is we're going to go and first break down a little bit about what the sort of background is to investment and what you can do and give you some ideas there. We're going to look at the different sorts of platforms that you've got and go over an approach that will hopefully make some sense as to how you can get there. So pretty much I'm going to make this really interactive. I've got you and I've got me. So I want to go and bring you as much value as I can during this time. So stop me, ask me questions. And if this is going down a route that you're going, I want to talk about something a little bit different, we'll go there.
I can get to know the investment of other countries.
So investment in other countries as well. Okay. So traditionally, what you're told to do for investment is save up money. And when you've got something like 5,000 or 10,000 or 20,000 or 100,000, that's when you invest. But there's a bit of a problem with that, because up until that point that you've got that money, you're not doing anything with it. So often, for example, you'll say, oh, I'm saving for a deposit on a house, and then I'm going to invest my money in a house. I'm going to save for my minimum term deposit amount, and then I'm going to invest it. And it creates a little bit of a problem. So my approach is pretty much, you should start investing now. Doesn't matter how much money you have, but now is the best time to begin investing. So there's a bit of an analogy. So let's say you're a runner, right? You're running at the Olympics. And let's say your first race is tomorrow. When should you have done your training? So your first race, say that your medal race is tomorrow. It's this big race. Everything's riding on it. When should you have trained for this race?
Anyway, I asked someone who is good at that.
Well, you should have trained before you run the race, right? If I walk up to the start line and I go, oh damn, I forgot to train, I'm stuffed. I don't care whether I'm Usain Bolt or whoever. If I don't train before the race, I've got a big problem. So why is it that we think that we can go and rock on up with our 100,000 or our 10,000 or our 5,000, and that's when we're going to start training to invest? Before that point, we don't want to do anything, because you go, well, I don't have that money yet. How can I do anything? But that's a bit of a problem, because all investment has risks, right? So if you haven't got any training, you're going to go and be running more risk, and you're not going to be as educated, and you're not going to know so much about what's going on. So instead of waiting until you've got that money, the best time to start learning and to start practicing is right now. Even though you might go, well, how can I do it? I don't have money. That's the part that I'm going to address. So here I've got a 6-step process. The first step is probably the most important step. You've got to work out, what is it I'm going to need in future? So say, for example, you can see I'm married. Before I got married, and well, even now, I've gone, well, I need to have a stable house for my family. I don't want to have somewhere that I lack control, so the landlord can kick us out anytime. I can't make the changes that I want. So for that goal, I need a house. For a house, I need money. And we're looking at the area I want to live is Raglan, and this is the sort of house that I want. So this is about how much money I would need, say $1 million. And this is when I need this money. I need a deposit of $200,000 in 3 years' time. And the more specific you can get with that sort of stuff on your financial needs, the easier it's going to be for you to work out, all right, well, how am I going to get myself there? What is it I need to do?
In my country, it is commonly we need $20 million after retire. So we have to be ready before the retire.
Amazing. So yeah, you've got to have a certain amount of money after you retire. So you work out that money, and then you go and say, right, well, how am I going to get there? And that's the second approach. Well, if you're in New Zealand, for example, you might say one strategy is I buy a house, I make money from the capital gains, and that money is going to be my return on my investment. Or maybe your strategy is to bet big on cryptocurrency and cross your fingers and hope that Bitcoin's going to the moon. It might or it might not. Or maybe your investment strategy is shares. But once you know how much money you need and when you need it, you can start to brainstorm. If you need a lot of money very quickly, it's probably a bad idea to start investing in bonds, because bonds have got a very slow, very predictable rate of returns, assuming that it's a government bond, for example. It would make more sense to either invest more money quickly or to go into something that's a little bit riskier, because you're probably going to need that rate of return in order to go and actually get to your goal. So once you've got to start with knowing what it is that you're actually wanting to do, and then you can go into those different investment strategies and work out, well, what could possibly work. But those are investment strategies for the future, not now. So the problem you're sitting there is you go, all right, well, I think I could do shares. I think I could do property. I think I could invest in cryptocurrency. Well, right now, these are just great ideas. How do you know what ones to actually implement in future and actually use? Well, first thing you've got to do is make the infrastructure. So you've got to get some basic working understanding. Well, if I don't know what cryptocurrency is, I sure as hell should not be investing into it, because that's the same thing as taking my wallet, giving it to a stranger and saying, do you mind, returning it back to me with a little bit more inside? So it always pays to know what it is you're investing in and the risks. So today as well, we're going to go through these a little bit more. I don't know what your background is, but I'll give you a bit of an understanding about what these different investments are and what the risks are. So once you've got that infrastructure, so say I want to invest in shares, I've got a good working understanding of what they are, the different options that are out there, how to look and see what a good one is versus a bad one is. I know how to buy them. I know how to sell them. I've got that basic understanding. Then it's time to practice. That's the most important step. So how many times, let's say you're sitting an exam, how many times would you practice, like going through past exam questions or assignment questions or tutorial questions? How many times would you practice before sitting the exam? A lot, right? But the thing is, how many of us practice before we buy a house or invest money in shares? We don't. But how do we practice? That's the thing. Because we learn best through practice, right? If I do a past exam question and I fail the question, that's great. I'm glad I'm failing the question rather than the real exam. So that's the thing. We need to try these things out so we can see what works and what doesn't, and then we can apply it so that when we've actually got a lot of money at stake, we're not making these basic mistakes that you've made already when you're playing around. So essentially my approach is start with a little bit of money. I've got a whole bunch of asset classes on the board here. So this is pretty much a broad view of the different sorts of things you can invest in. Some of these, you need a lot of money to get started. Others, you need $1. And it's much easier to get started with an asset class that you need $1 than $100,000. So those are good ones to go and start thinking about now and start learning and practicing now. So let's go through it. Well, what does this actually mean? The words on a board. So cash. Physically, if you've open up your wallet, oh yes, here we go. This is cash. So as you can imagine, this does not magically turn into more money. If I open my wallet in a day's time, it's still $25. You can play around a little bit. Like, let's say I change this into, Indian rupees, and the exchange rate is favorable, and I change it back and it's favorable. There we go. I've now made a bit more money. Or maybe I put my cash in the bank and the bank gives me some interest. There we go. Made some more money. But typically you'll find cash is the most secure sort of asset because this is literally money, but you get quite low returns. So that's the cash sort of side of things. Shares is the next one. So we'll get into shares a little bit more, but what a share is at its most basic level is if you think of a company as a pie, a share is your slice of that pie. It's you own a part of the pie, which is the company. That's what a share is. And the company has value, so your share has value because it's part of the whole. And you can also sometimes be paid money from having a share, dividends. Bonds are kind of like IOUs. So those ones we don't hear about so often. So say you're the New Zealand government and the cyclone's just come through and you go, damn, that road in the Coromandel, it's gone. What am I going to do? I need $1 billion now. So what they do is they say, everybody, pay me some money. And I promise you, if you pay me money, I will pay you back with interest. So people, it's a bit like an IOU. I give you, this is the same concept except with the government, it's writ large. If you're the government and I'm an investor, I say, here you go, government, that's $20. And then you say, all right, in 10 years, you'll give me this back. And during those 10 years, I don't hold this $20 right. So you've got to make it worth my while or else I'm never going to give the government my $20. So you pay me interest in the meantime, maybe $1 or $2 over the 10 years. And then it's worth my while because I've given you the money, I've got it back, and I've got some interest.
I think this rate is
not. But that's the thing. It's not just governments that issue bonds. So there's other people as well. So companies, for example, issue bonds, but there's a bit of a risk. Say I've got this new amazing idea and you should pay me your $20 and I promise, hand on heart, I will give it back. I don't sound so trustworthy now if I'm a company, right? So riskier bonds, they have to pay you more money or you'll be just sitting there going, nah, not worth the risk. So that's another thing to consider too. There are more than one types of bonds. They're not all created equal. But that one, I think, is one of the ones that we hear about less frequently, but they do come up. So when we get into KiwiSaver, for example, and other retirement investment, you will see bonds. They will come up. Commodities is another thing. So again, you might have heard in the media, people say, invest in gold, invest in silver, invest in these precious metals and these things like timber. All of those sorts of things are commodities. We're not too worried about it because, frankly, you can buy a whole bunch of gold and have it sitting around in your basement or in a bank vault, but it's less common. Essentially, you're just buying it and hoping the value of it will go up. That's really what it is. It isn't because gold is inherently more precious than it was previously. Property as well. I buy a house. If the house goes up in value, yay, I've made some money. When I sell it, that is. Cryptocurrency speaks for itself, but there's all sorts of different flavors, and that's getting more and more complicated. There's some things like non-fungible tokens, which are also out there, which I have got a hate relationship with, but we can get into that later. There's collectibles as well, like artwork. Some people you'll find like trading cards, antiques. Again, this is quite niche in currencies. You can play around with that too. So this is your overview of all the different things you could invest in. But now we've got to actually look at the ones that you can actually play with. So if you've got money in a bank, you'll see that when you want to do a term deposit, there's often a minimum amount you have to deposit because they're going to give you a higher interest rate and they'll often reinvest your interest. So it's going to be compounding rather than non-compounding. You'll find that often it's 5,000 as the minimum amount in New Zealand for a term deposit. But you can put your money into a savings account, which offers a lower rate of interest. And then you will often find that there's either no requirement whatsoever for a minimum amount. So you can just play around and do whatever you like and see what works. So that's actually quite useful because then you've actually got a chance to go, come on down.
Hello, hello.
Good to see you. You're a little way through, so you can see the numbers are small, so huddle in tight. So we're partway through the seminar right now. We've been going into the different sorts of ways that we can go and invest and get some knowledge without necessarily having a whole lot of money.
Yep.
And the premise behind it is simple. It's that if you were an Olympic runner like Usain Bolt, you wouldn't start training on the day of your medal race.
No way.
So if we're going to go and invest, say, 100,000 or 10,000 or whatever it is, why start learning on the day of the investment? Why not practice beforehand and develop that infrastructure beforehand, if at all possible? And we're going through the methods how.
Amazing.
So first up was cash assets. So you'll also see that there are differences. So we'll start talking about term deposits versus saving accounts. There's a hell of a lot of differences between the banks. So you'll see Kiwi Bank offers very different setups for their saving accounts compared to ASB. Like with ASB, if you don't withdraw your money, you're going to get bonus interest if the account is set up in that particular way, and you're only allowed to withdraw it on certain days. Kiwi Bank's another story, ANZ's another story. So really shop around and give it a try. See what works for you. There is no rule saying I can only bank with ASB. Hell, I've got a Kiwi Bank account, I've got an ASB account, I'm thinking of opening other bank accounts just because I want to shop around, and it doesn't hurt me to move my money from one bank to another when one bank's got to give me a better deal. So you're better off having just a play and just seeing what works for you. But bear in mind, minor banks, you can hit an issue. So your major banks, you'll find, will often offer lower interest rates compared to your minor banks. And that's because your minor banks might say, okay, well, we've just gone bankrupt. You know how you've got this money inside our banks? Sucks for you. Don't got it anymore. Or rather, you're going to go and have a reduced amount when they go through the whole liquidation process, unless the government steps in to secure it. So you're getting that reward of a higher interest rate, but at the risk of a higher chance of you losing your money. Bear in mind, for the major banks, you still got that risk of losing your money. It's just a lower risk. But often what will happen is that the government will step in, because how many people bank with ASB, for example? A lot in New Zealand. So what are the chances that if ASB goes bust, that the government is going to step in? High, because you've got a lot of voters that are going to be pissed off if they lose their money, and then they say, oh, government, you could have done something. Why didn't you do something?
Right.
So often the big banks are a safer bet than your minor banks. But if you've got your money in the bank, it's probably not because you want a really high rate of interest. It's probably because you want the accessibility of being able to use it when you want it.
Yeah.
But have a play. Shuffle your money around. So which banks do you guys bank with?
ASB, Kiwi Bank. I do if I'm doing savings, right, I put in another bank because it's harder to take 3-4 days to get it out. Stops impulsive buying. Yeah, so, but Kiwi Bank's like the main one I use, but then ASB, we like put it in there as well. I think my wife is going to go for Westpac to put hers in as well, but she's doing her own research and stuff as well. So we're trying to do what you said as well, right? Just have a look at which ones you're doing for what you want. Yeah, but it's fun. We didn't know how different they were until we had a look and went, wow, why does it do that, you know? So it's interesting you bring that up.
It's all, yeah, what ones do you
have
bank?
a Kiwi Bank account, because I could open the bank account soon. But I think that because in my country, there's no interest. So, yeah.
What country?
I'm from Japan.
Japan? I lived in Japan for a little bit. Yeah, in Tokyo. Yeah, that's so cool.
It's a good country.
Yeah, you got that. Like when I was in Japan, I think they could borrow money for like 1%. This was like 2012, 13.
Wow.
Yeah.
That's insane.
It's insane.
That is a really, that's mind-blowing now.
Yeah.
But yeah, you've definitely got to go and think about that. And the more you can just have okay, I'll be honest. I'm a really intellectual person. I can think about all of this scenario and that scenario and the other scenario, but I don't learn anywhere near as well if I've got my money, skin in the game. That's when I learn best.
Yeah.
I tell myself I'm so smart. I'm a really clever person. I can work all this out. I don't need to do this.
Yeah.
You're better off every time putting your own money in because you feel the pain when things don't work out and you learn the lessons that much better.
That's a good point.
Yeah. Believe me, I'm a victim of my own intelligence. I tell myself, I'm smart. I can just work it out. And it's always better, I found, to just experience it for yourself. And in a similar line as well with shares. So I don't know how much you guys know about shares, but essentially there's 3 different things you can do. You could buy shares in an individual company. I could take something like Trade Me and have a slice of Trade Me. I can go and take Fonterra and have a slice of Fonterra. Or I could buy a share of a fund that, say, take an index fund, for example. They might say, let's look at the top 50 companies in New Zealand, and we're going to have shares in all of them and weight it compared to how big they are. And if you want to put your money into our fund, you'll get a slice of the pie. So that's one approach. And you've got exchange traded funds as well. There's not a huge amount of difference between the two. They do a similar thing, except you'll find the fees for index funds are typically lower because they follow an index like how big are the companies, like take the top 50 companies. Whereas exchange traded funds, you often have a person like you or me with a strategy of what they're going to be buying and selling, and then they're going to go and charge you for that time. So index funds are typically the cheaper option of the two. And historically as well, they have tended to be outperforming most of the other options on the long term. So it's quite funny. People think that we're really clever at guessing what the winners and the losers on the stock market are. And in the long run, if you take the top 50 biggest companies, you're going to beat nearly every single person that thinks that they're really clever.
Yeah.
Which says a lot.
Yeah. I think I was reading there's that book, The Psychology of Money, and it has just look at Buffett's strategy, and he just has like heaps of those, just like a long time, right? Yeah. There's that quote, right? Instead of time in the market is better than timing the market.
Yes. And time in the market is something we can get right now. So shares in the past, you'd go through a broker and it would be quite difficult to go and buy them. Now, get Sharesies, get Hatch, get direct broking, invest now, stake, put $100 in. So what I do myself is I say, I've put $100 in Sharesies, and that's my money to play with. I treat that as dead money to me.
Yeah.
This is my investment I've made in my own education. If that balance goes to zero, I don't care. Because what I'm going to do is I'm going to try making transactions. I'm going to try buying and selling. I'm going to try timing the market and getting myself smashed. I'm going to try all of the different things I can do with it, spend my $100, and at the end of it, I've got all this knowledge. So I'm not going to make the same mistakes when it's time for me to put in 10,000, 20,000, 50,000. I'm not going to be doing the rubbish that lost me money when I had $100. You could invest $1 in if you liked. I mean, you probably better do at least a little bit more. But that makes investing actually accessible in a way that you don't have for other things like property. Or rather, you've got to get a little more creative with property.
Because prior, like you were saying, right, we have to go through brokers, whatever, work through them to do stuff, and then they would take the heavy load and the opportunity to learn the knowledge and experience yourself. And of course, property has a pretty high entrance barrier with money, so it's cool to have Sharesies and those things because you can, as you said, get your own experience and knowledge from experience, right?
Exactly, and then you've got the chance to maximize your funds. So take, for example, the different fees that you can have. Well, let's say that you take, because you were asking before about investing in different countries, take Hatch. I think they're based in the US and you can invest worldwide, whereas Sharesies, that one now they've got those features there now, but I don't think they were originally there. But if you want to go and take your New Zealand dollars and turn them into US dollars, well, they're going to go and charge you for converting that currency. If you want to go and buy something, they're going to go and charge you fees for the courtesy for you using them to buy or sell. And if you're going to hold things on the platform, they're going to charge you a certain amount to manage it. So when you're playing with, say, your $100, look at the fees. Work out, well, if I was taking these different approaches, do I pay more fees? Do I pay less fees? And how does that affect my returns overall? maybe you'll find that if you are buying and selling a lot, you're going to find that your brokerage fees are quite high because each time I buy or I sell, I pay the platform some money. Pretty much they put that in place so that people who think they're smart and want to try to time the markets, they end up paying the platform a whole lot of money.
A bit more.
Exactly. Yeah. So those are the sorts of things that you can really get a hold with and play. So I don't recommend just looking into what you're investing into, but also the fees, and just give it a go. Don't worry about whether you're executing the best strategy with your $100. That's not the point. The point is to give a few different strategies a go and then work out for yourself what works for you.
Right.
And it doesn't also just play into the monetary outcome. Look as well about how you feel. So take, for example, my wife. She has got a really anxious disposition. And imagine that she was buying and selling every day. She would just lose so much energy. Yeah. And every time she makes a bad investment and she's loses money on it, she would be out for the whole day. There's no point. So that would mean that sort of like you just see how it makes you feel. Whereas with other people, they'd get really into it and go yes on every big win, and that would then make them more productive for the rest of the day.
Sure.
So the investment approach, you take fees and like the money outcome is one part, but also look at how it makes you feel and how it affects the rest of your life. Because if I'm happy and I'm motivated and I'm feeling good about myself, I'm going to do better in the rest of my life than if I'm feeling down and sad and anxious and always checking, got to get my phone out. Has it,
Yeah,
what's going on? What's going on?
Drop.
Exactly. So just be really careful on that side to not just look at the money when you're going and assessing what works for you and what doesn't.
I suppose you could use the same line of thinking with like different KiwiSaver fund providers, right? Because we've done a little bit, well, not a little bit, but a lot of research, and the KiwiSaver providers, they're so different. Banks are different. Some have percentage fees, others have fixed fees, others like to time the market, others like to go with the market. You know? There's a few different providers now, and they're really interesting in their philosophy around investing. Like there's one called Coda, and they now do crypto as part of their portfolios.
Wow.
Yeah, there's Juno, which is a managed fund, and they try and time the market. And they try and save if the market's dipping, they have a lot of their portfolios cash to liquidate and stop that dip. So it's interesting to see what, but look at the fees, like you're saying, different fees.
And have a play as well while your KiwiSaver balance is small.
Yeah.
Because when it's large, you're not going to want to change it between providers and give things a go. There's no cost to change between providers for KiwiSaver, so do it, especially when it's small and you're just getting started. So in Japan, like I don't know whether you have a superannuation fund in Japan with different providers, but if you do and there's no cost changing between them, just give it a go. See what happens. Say you take a hit of $200 now, but you've got the knowledge to save you from a $10,000 dip when you've got a lot of money in it.
Yeah.
I'll take that any day of the week. Essentially, the sooner you can get knowledge, the better by a long shot. Knowledge is really, truly valuable, especially now. It's always going to be valuable, but it's most valuable now.
Yeah, absolutely. I like your way of thinking.
Now, there's another thing as well to think about. So when you've got investing in something like Sharesies or you're in FTX, you're going and playing around with crypto in an FTX, what happens when it goes bust?
It goes, the market is pumped. Is it not just the FTX when it's happened? Or, the market went down, tanked a lot.
So you'd have a fair concern. Well, what if I use a platform like Sharesies and I lose all my money because Sharesies goes bust? If it works properly, there's a thing called a custodian. So imagine I've got my money here, $25. And this is Sharesies there. So what I do is I say to Sharesies, here you go, here's my $25. And Sharesies says, right, well, this $5 we're going to keep because that's our fees. And this 20, this is your investment. This goes over here to our custodian. We do not touch this. So this $5 they will play with that they'd use on their day-to-day running, but they don't touch the $20. So that means that if Sharesies goes bust, you should be able to say, give me my $20 back, and the $20 comes back. That's the theory. But in practice, it works out pretty well most of the time. But take a look at these headlines. So FTX, for example, it went belly up, and it turned out that there was a lot of fraud going on, and billions of dollars of the money that was sitting here, they took and put it here so they could take it away. And then you've got the investors saying, "Where's my money?" Well, it's gone.
It's gone.
Yeah, exactly. So that's why there's such a big outcry about that. And it puts you in a difficult position because you've got to go and work out, well, if this company, if I put my money in Sharesies, I need to be pretty damn sure that if they go bust, I'm not going to go and have my $20 go walking off. So it's like the sort of things I'd look for if I'm investing would be a reputable company, so preferably one in New Zealand, because then I understand the laws and the legislation better, but I'd also consider something that's based in, say, the US, other major countries that have got a good sort of background there. Something like Ireland and a tax haven, maybe not. Luxembourg again, tax haven, maybe not. Cayman Islands, maybe not. India, maybe not. Yeah. But just keep an eye out. I wouldn't. So if you're playing with a small amount of money, like $100, it's worth the risk probably.
Yeah.
But if you're playing with a lot more, be really careful. So essentially you could lose a whole lot of money if they go bust. So whenever you're thinking about putting your money in a big asset, just consider the worst case scenario and work out how protected am I from this really. If you're buying property, I'd be considering sea level rise. So it's like at the moment, we might have several meters of sea level rise already locked in thanks to the West Antarctic ice sheet being undermined. When it goes, well, sea level's going up by 4 or 5 meters. So I wouldn't be buying a house 3 meters above sea level. That's really just asking for trouble right now. Yeah. People are doing that though.
Yeah, interesting.
So you'd want to go and make sure that you think about that worst case scenario. I wouldn't really want my house on and outs in floodplains. And in the same way, I wouldn't really want to have the custodian of my money in say, a company like Sharesies being based in India. Nothing against India. Yeah. It's just that I would rather be safe rather than sorry.
Yeah. That's a really good point.
So, well, what about KiwiSaver? You guys or your other superannuation funds. So this is where you often will find that things get really complicated because you've typically got fund managers and they've got a mix of everything under the sun. Yeah. They've got foreign currency here, bonds over there, shares over there. It gets complicated fast. And the reason for that is partially they want to confuse the hell out of the customers so they don't know what to do. They'll just say, thank you, it sounds good what you're doing for me, take my money. Yeah. And it's hard to compare. So if in doubt, I really would move your money around. Just see what is working for you and what isn't. Just be careful, though, about moving money for the right reasons. So if I'm just playing and I'm going, I just want to see what's going to give me better returns, cool. If I'm just playing and going, what's the fees going to do? Cool. If I'm going, oh shit, the share market, it's just gone down by it's just gone down by 30%. I need to move my money out now. Don't do that. That's how you get yourself into trouble. That will teach you a very hard lesson. You will get educated, but if you're talking about a lot of money, that is typically not a good idea. So your loss is already typically locked in at that point. You're probably going to be better waiting for the long term.
Yeah, I saw a lot of people do that last year, actually. Things are just going down a little bit. Ukraine war, etc. People were panicking. People were changing, and they're saying, "Oh, it's losing money," so they pulled it out of their KiwiSavers, and then they took the loss because you can't get it back once it's taken out.
Exactly. And if you're inclined to do that, then I wouldn't be investing in shares in the first place. Because if you're this is the thing, right? Like ultimately your emotions play a huge role in investment. And if you're going to panic when markets go down, you shouldn't be in a risky investment, because when you're in a risky investment, markets are going to go down. They'll go up and they'll go down. It's inevitable. So you're setting yourself up for when the market's going down, you're locking in losses. There's no point doing it. So if you've got that sort of disposition, better for you to go for something safer and just accept you're going to get less money, but you're not going to panic and lose yourself a lot of money over the long term.
For example, COVID.
Yeah.
COVID now, everything is go down.
Yeah.
So what the people think? I don't know. People. What? Sorry. What the people do that at that time?
When money went down, what did they do?
Everything is down.
I'll let the teacher answer that one.
All right. So say that the share, I was just looking for a whiteboard marker to see if I can draw it, but there's none. So
No,
never
you
mind.
look for one.
No, don't worry about it. I'll just do this off. I won't bother doing it visually. So everything went down, right, due to COVID. Well, what a lot of people did was they went and said, things are going down, time to sell. So if you bought here and the market's dropped to there and you sell, you've lost this much money.
Yeah.
And other people were forced to sell. So that's what we'd call a fire sale.
Yeah.
That's the term. So essentially you're saying, well, I'm in financial stress. I've got to sell my investment. I don't have a choice.
Businesses, etc.
Yep. If a business goes into liquidation, or you can't pay your mortgage and you've got to sell your home, that's what a mortgagee sale is.
Yeah.
That's when you really take that loss. Other people went and said, now, prices have come down. I'm going to start buying. And then, yeah, exactly. And then when the prices go back up, they take that gain.
Yeah.
But the problem is that you never know whether the market is going to drop this much and then this much and then this much and then go up and then drop that much, or whether it's going to go down a little and up. You could take an informed guess. It's like you could see with the war in Ukraine, you could get, and like take COVID, for example. Early on, I went, well, shipping is going to become really important and really expensive, and there's going to be issues here. Like you can take some informed guesses, but you aren't going to be right all the time. You aren't going to be right most of the time. So if you're investing in shares, it's because you want to make the return over the long run.
Yeah.
If you're playing the market, be very careful. That's gambling. And ditto on cryptocurrencies. That's really gambling. And I think I said it in a previous seminar, if you're playing with NFTs, that's flushing your money down the toilet at that point and hoping that more's going to come out on the other side. Yeah. I have a real hate relationship with them. Yeah. So essentially, anyway, bonds. Where was I at? So KiwiSaver, you've got a whole bunch of these different investments going on. So actually getting some experience and trying this out for yourself is amazing to do now. A lot of people will just set it and forget it. Don't forget it. Just try different things. Even if it's only 1 hour every week that you're spending on it, you're going to learn so much. Bonds are difficult to play with. Now, essentially, in the last 5 years or so, we've had people say, okay, so shares in the past were difficult to get into as well because you had to have a minimum investment. And what happened essentially was people got together and they said, well, I bet that millennials want to invest in shares if it was more affordable. So we'll go and pay for a whole lot of shares and they can invest as little as they like. We'll make it really easy, really convenient, and then they can learn. And we can make money off that, and hence you got sharesies. I'm making a prediction. We're going to get more of this in different areas that currently there's not much of that going on in the mainstream. Mm-hmm. Bonds, there isn't much of that yet, but that could change. Essentially, we were explaining what a bond is before, how it's like an IOU. I give you $20, you give it to me back after 10 years and you pay interest in the meantime. Yeah. You'll find that when you want to go through Kiwi bonds, when the government is paying you, like you've got the bond with the government, there's minimum investment amounts and it's you might find that corporates as well, like big companies as well,
Mm-hmm.
they're probably going to do something similar.
Right.
But I'm not. There should at some point be some sort of solution that will let you invest smaller amounts.
Yeah, with bonds, right? Like the shares is equivalent, but for bonds, something would be coming out. So
Yeah, there's probably like if we really hunt, we might be able to even find something, but it's going to be something that's pretty new and not mainstream yet.
Yeah.
So again, something to play with, to learn about. Because take, for example, interest rates. Well, say that I'm paying $1. This is getting in a bit more depth of how bonds work. So say that we have got $20. All right. So I'm giving this money to the government.
Yeah.
Here you go, government. And they are giving me interest. Now, if they give me, let's say that if I put this $20 in the bank will give me $1 interest each year.
Mm-hmm.
And the government says, well, I can see the banks are doing $1, I'll give you $5. I'll go, cool, I'm going to go with the government, thank you, and get my $5 interest each year. But if the bank said, well, I'll offer you $6 interest each year, the government is going to say, well, I can't offer you $5 because you're not going to go with me, so I'm going to have to offer you $8. So what that means is that over time, new bonds will be issued with different interest rates. And as you can imagine, if there's been a lot of bonds around with giving you $5, and suddenly there's now bonds that would give you $8, when you're trading bonds, like buying and selling bonds, like I can sell the right to get the $20 back to you, and then it's worth a certain amount of money. Essentially, bonds have a value as well, and it's really heavily tied to interest rates. If interest rates go up, then the banks look more competitive, and the government changes the interest that it's issuing, and it affects the value of older bonds that were at lower interest. Typically, they're less valuable. And vice versa. If interest rates go down, then those old ones that were paying more look really valuable. Again, you don't need to know the mechanics. If you don't follow it, don't worry about it. But the point is, it's hard to intellectually get it. Try putting some of your own money on the line, then you'll really get it.
Chuck some emotion on top and everything.
Exactly. When you take that loss, that's when you get it. And why not use $100 rather than $1,000?
Cheaper lesson for sure.
Exactly, and will be just as big of an emotional blow. So that's why I recommend start with playing with the things that you can invest those smaller amounts of money. So shares is a really good one. Crypto is a really good one. Even though it's gambling, you might as well learn how to gamble rather than if you've got $50,000 on the line. Learn whether it's a good idea. Don't just listen to me saying that NFTs are like flushing your money down the toilet. Actually,
yeah, for sure.
Yeah, actually try it and see for yourself how fast your investment goes to zero.
Yeah.
But yeah, just start with a small amount of money. And there's a whole bunch of retailers that are out there. Again, giving you some background with crypto. So you know how I was talking about custodians, right? And saying it matters who has got your money because they've got to be trustworthy. Crypto, there's two ways you can buy and sell. One is when the wallet, crypto, person that's got the wallet owns the asset. If I'm holding my wallet, I've got the asset. If you're holding the wallet, you've got the asset. Some of the websites you go through, if I buy from you, you're giving me crypto and I hold the asset in my wallet. And other websites, you own the wallet. And I've got a share in it. You can immediately guess what one would I prefer to invest in, one where I'm holding the wallet because it's safer. And typically you're going to make less return on those because, again, the retailers that are holding the wallet themselves, they're willing to go and pay you more money for making investments on their platform, charging lower fees. So essentially they're trying to entice you that way. But just be very careful because when these websites have gone bust, if you've got your wallet, you're okay. If they've got your wallet, you might not be. So just be really careful.
The custodian factor is a big key. What sort of determines the custodian, I suppose, soundness, if that makes sense, right? One being reliable or having, I heard you mention reputable, which is always good. Obviously, countries with like more solidified legislation, etc., on them What's some other factors that you look at when looking at custodial?
You want to make sure, pretty much those factors you've just outlined. So you want to make sure that you're in a regime where there's a big stick if you break the rules. Because take, for example, New Zealand, if you stuff around and you break the rules and you try doing something like interfering with the custodian, first off, it's going to be really hard to do because there's a lot of accountability. Second, you're going to have a very big stick because you've breached your director's duties and you're going to be personally liable, and you could be sure as hell that your creditors are coming after you. So you're going to really get walloped there. Whereas if you do it somewhere where they don't have such strong protections and that's where they're based, then there's less of a disincentive to committing fraud.
Makes sense.
Then again, you do have issues going on in the US and other things too. So just because you're in a good country doesn't mean that you're immune. So yeah, it's complicated is the short story, but it's more just something to be thinking about.
Yeah.
Whenever you make an investment, always worst case scenario, and you try to minimize that.
Yeah, absolutely.
But not at the cost of not making an investment at all. I guess I could take my money and shove it under my bed, but I'm never going to make a return if I do that. So you've got to have some sort of balance between potentially losing your money and making money.
Yeah.
So don't blow it out of proportion. Not trying to fearmonger completely.
Yeah.
So, sorry, we're going backwards rather than forwards. Directly growing money. So you've got other options too. So take something like property. You can get together with multiple people, and then instead of needing, say, $200,000 deposit, you can have something smaller. And again, I get the feeling that this is going to become more and more digitalized. There's going to be more and more platforms that offer. It's like I can imagine. Like okay. I'm pretending I'm the marketer now for this imaginary platform like Shezzy's that deals in property. Yeah. Get your foot on the property ladder now. Absolutely. Why wait until you are 50 or older to buy your first home when you can get your share now? Yeah. Get started today. For sure. I could see that on the ads doing so well with people like you and me. Yeah. I agree. And I'd actually tell people, give it a go and like get some education, like invest a small amount, just have a play, see if it works or not. But make sure that you treat that money as a payment. It's like in my budget, I would mark that as I've paid $100 towards my education rather than I've just moved $100 from one account into another. I treat it as gone as soon as I've put it in. So then I'm actually feeling willing to play around with it.
Yeah, absolutely. That's pretty nice.
Yeah. So investing in groups, that's always something you can do, because if I've only got a small amount of money, I can magnify what I can do by adding that money into others. But you've got to be careful with the group. So if you've got a company, for example, like let's say we're all forming a company together, you've got to be really careful that you know who you're dealing with. Because if I turn out to be some fraudster, you're screwed.
Yeah.
So if you're investing in a group, that's great if it works, but you've got pitfalls when it doesn't. So just be careful. When you've got more than one person, you're no longer just relying on your own credibility. The other thing you should really think about too is, right, well, even if I can't get started now because I don't have a deposit for a house, go to some of these property investor talks. Yeah. Go to some courses. Hang out on the Facebook pages that they exist in. Like, make some friends. Ask them, what's your strategy? What do you do? Maybe follow along with them as they make an investment. You'll find that a lot of these people like to talk. They like to help people as well. And if you ask, say, 10 people, hey, I'm interested in what your strategy is. Can you tell me a little bit about it? I'd like to learn something from you. Maybe 5 of them say, no, go away. And then 5 of them might say, yeah, sure. So it's just worth a go. If you're willing to put yourself out there, you'll get some good results. So that's working with investors is another one too. Say you've got, you're in the university student sort of life and you've got time to do a summer job. Why not go and sign up, knock on the door of a property investor and say, hey, I'd like to go and work with you. you don't even have to pay me because I'll really value the experience, or maybe they will pay you. So when my wife was, I think she was 16, she went and essentially answered an ad in a paper for a property investor, and the property investor was shocked because she didn't think that like a minor was going to be answering the ad, but she ended up getting a whole lot of really good experience simply because, well, she was following the property investor around. She saw how she made her money, what decisions she made, what decisions she didn't, what apartment buildings she would invest into versus wouldn't. You can learn so much just by being around these people and seeing what they do, because you're not just listening to them, you're actually observing it and experiencing it through them. It's like me talking here right now. I can tell you about custodians and this and that. You'll get, say, some of that knowledge, but if you experience it, that's when you'll really learn it. But yeah, I can't stress enough, just get involved and get stuck into it.
Yeah.
So creating skills. Essentially, you've got the ability to make successful investments now by developing your skills. So I'm a big fan of emotional skills. And last seminar, we really got into this because we were talking about how people pleasing was a big issue with being able to negotiate successfully. Because if I'm wanting to please somebody, I'm not going to really be able to I'm going to really struggle to negotiate and say, right, instead of $300 a week rent, I want $280. And that's going to really cause issues for you down the line. But there's a whole lot of other emotional things that can hold you back. Maybe you feel like you get overwhelmed really easily in your life and it's difficult for you to keep an eye on things. Well, if you've got an active investment strategy which relies on you reading the market and working out whether it's going up or down, if you're getting overwhelmed all the time, good luck. It's not going to work. So you can really work on your emotional, like what it is that you struggle with. And that has probably got the biggest unlocking factor, I think, for finances. Yeah. It's the most underrated thing, but it is really, really key to overcome your emotional hang-ups.
Yeah.
Knowledge as well, of course, like you're here, right? This is giving you more knowledge, and then you're going to be able to learn more about investment, and then you can go away and make better investments. That's something you can do regardless of whether you're investing. And the other thing is, which is massive, is reviewing what it is you've done. So say I actually went out there and I did an investment, put my $20 in, and then I never look at it again. What am I going to learn? Nothing. So it's really helpful for you to be actively looking at what it is you've invested in so that you can really take on those lessons and learn. Because if you don't look at it, you've got no hope of learning from it. So overall, this is the process which I recommended that we follow. First off, look into the future. What are your future financial needs? So that links back to goal setting. You've got to know what your life goals are, and then you can say what your financial needs are in order to meet those goals, and then you can work out, well, how am I going to meet those goals? So I was using the example of, well, I'm married. I want to provide a secure home for my family. I don't want a landlord to just be able to kick us out. I want to have control over the property. For that, I need to have ownership of a house. Yeah. For that, I need the money. And I need to go and then you look at it, right, what sort of house do I need? And then I can work out how much money. I then have to work out, all right, what do I want to do in terms of time frames? And then I know when I have to come up with the deposit and what size of the deposit. And then I can say, all right, well, this is how much money I need by that time saved up for a deposit. Now, what's my strategy to get there? So that's how you get to the strategy point. And infrastructure is that background. It's the knowledge that you need in order to make a good investment. If I don't know anything about shares, I'm not going to go and be able to go and make a good investment in shares. Get that shares account, play around with it, get the Hatch account, play around with it. Just give things a go and learn and get that infrastructure and those systems that you need. And then you can actually, if you can experience before you make those investments for yourself, how these actually work, so much the better, because you're going to learn way more by doing that. Then you're learning now how to optimize your future investment rather than doing trial and error before it matters. You're like Usain Bolt training before his 100-meter sprint rather than trying to just do it cold turkey and finding that he falls flat on his face.
Yeah.
And then you can actually run that 100 meters, you can actually invest that money, and you're going to go and be able to go and get those gains from it.
Do you think which task is most difficult?
Sorry?
Which task is most difficult?
I would honestly say going in cold, the first one. The first one. So we've done a seminar on it before, but essentially the hardest thing is to know what it is you want to do with your life. It's like if I told you in 10 years, how much money do you need for your key financial goals?
Yeah.
Do you know?
I'd agree on that 100%. Most people that I've met and talk about money, it's just they have like a lot of knowledge about things, but then the clarity on what they actually want down to like a numerical value, no idea.
And that right there is what I'm getting really clear on right now. So it's like this weekend I've got a retreat that I'm going on, and I'm trying to go and pretty much I'm trying to get myself really crystal clear. I'm following this process myself because I've gone, well, the objectives that I had aren't aligning anymore. I've got to throw out some of the old, bring in the new, realign, just keep reassessing. And then I'm able to actually go through and follow this, because I was finding that I was having a period where I was getting really unmotivated, and because things just weren't aligning for me, I was hitting all of these roadblocks and just finding I wasn't putting my effort and my time and my energy into the things that really were important. And I'm just going, what is going on? Why am I not like, I know what it is I need to do. I've got the ability to do what it is I need to do. Why am I not doing it? And that's because I just had this misalignment going on. What I thought I wanted wasn't what I actually wanted, and I have to get clear on that.
Yeah.
And this weekend again for me, I'm going, thank God I've signed up to it, because it's about damn time I sort some of this out. It's like, again, you'll notice there are only 2 people here because I didn't put enough effort and time into the marketing of this event when I needed to do it. So there's not so many people. Again, that's because I've been struggling with some of these things myself.
Yeah.
And I've gone, right, I need to deal with this and approach it. And then next seminar, I'll have been doing the jobs that I need to do in order to get a healthily sized community. Now, normally what we'd do is we'd be asking questions throughout the seminar in order to go and then work out who gets the prizes. But we've got 2 lovely participants. So if you guys want to go and write down your name and your email address, what I'm going to do is give you guys some free coaching. So what we'll do is I'll get in touch with you guys through email, and then we'll go and arrange a time where we can do some one-on-one coaching and help you out with what you're struggling with on your finances. So I hope you guys enjoy.
Oh, that was amazing.
That's it. Thank you for coming along.
Yeah, no, that was good. Did the last one go all right, the last seminar?
It
was
was
that one.
really
Was
good.
that just sort of a more emotional skills one? That one.
Yes, it was really good actually. It was cool. I will get out the food as well. So it was called Spending Hacks, and what we did was we were going through, and it was quite interactive, but people were going and sharing what it was that they do in order to go and save money.
Yeah.
And how to make money work for you.
Yeah.
And we were finding when we were getting into things like negotiation, because that's one of the best ways you can save money, right?
Absolutely.
Then people were finding that they had some real hang-ups and some real difficulties around that.
Yeah.
And the question is, well, why?
Yes.
And that was then coming back to emotional reasons. It's like myself, I'm a people pleaser, right?
Oh, right.
So I like to make people happy, and I don't want to disappoint
Most
them and let
people
them
do,
down. Yeah. But that means I will really struggle with this sort of thing.
Yeah, that's so cool.
So, and again, that really resonated with a lot of